Good morning.
Good morning, sir.
Good morning, sir.
Good morning. Very early morning. So thank you for joining. As we discussed or informed last week, we are having the session bit early today, and I really thank you for joining. And I see still people are joining, but let's start and continue uh, because I plan to discuss this monetary policy section today, and also to go into the other slides as well. Can you see my slides on the screen?
Yes, sir.
Okay, thank you. Right, now last week we discussed monetary policy and why it is important and what is the role of role of the monetary policy, and we realize uh, in the in an economy or a financial system we have to maintain low inflation. Low inflation is one of the prerequisites for economic growth and also for other important economic activities like to make investments, for people to make better economic decisions, for secure their savings, to safeguard their uh, uh, purchasing power, and ultimately to ensure the well-being or the welfare of the society. We need to have low inflation. To have low inflation, we understood we need to have some policy undertaken by the mainly by the central bank, and that was basically monetary policy. And under monetary policy, we discuss various policy variables. Variables in the sense tools. What kind of a tool that the central bank has to implement monetary policy? And we discuss the policy interest rates. Policy interest rates are basically the main or benchmark interest rates in the economy, which are determined by the central bank. And we saw how the central bank can change the policy rates time to time. And with the policy rates, the other concept we discuss is the open market operations. Under open market operations, central banks are buying or selling securities to absorb or inject money into the economy. When there is a kind of a recession in the economy, which means low inflation is there, central bank can inject money by purchasing securities. When there is high economic growth or high inflation risk in the economy, central bank can sell its securities to absorb money. So that process, you call it open market operations. This is the most popular monetary policy tool that the most central banks use in modern world to absorb or inject money. By absorbing or injecting money, central bank can keep the interest rates at the levels they want. That is the idea of open market operations. We discussed reserve requirement. We discussed reserve requirements in many instances. And here also last week we reminded reserve requirement as a monetary policy tool that can have an impact on the money supply through money multiplier. And we remember when we change the money multiplier, increasing or decreasing money multiplier has negative or positive effects on the money supply through multiplier process. I think you have that in your mind very clearly. And also I mentioned some other instruments as well: special deposits, moral suasion, direct controlling, forex transactions. All these are used by a central bank uh, in conducting its monetary policy. And also we looked at some new type of tools which have emerged or which have been popular after the global financial crisis. One is macroprudential tools, which means taking actions basically focusing on the financial sector, the stability of the financial sector. Those are also considered as both monetary and financial tools. Macroprudential means that. And then we looked at unconventional monetary policies where central banks cannot use traditional policies when economy is in a kind of a deep crisis or a recession. So during that period, central banks are able to use some other uh, instruments like purchasing of government bonds, private bonds, having negative interest rates. All these are considered as unconventional monetary policies which are used by certain countries during a crisis period. So those are the instruments we discussed, and I told you those instruments are in your exam papers time to time, sometimes as direct questions in the sense you can answer what it is, but there are some other questions like indirect questions where you have some incident or some issue is given and what kind of a policy can be applied and what type of outcomes you can expect. There are questions like that as well, so you have to be prepared for both type of questions. Then from that point onwards, we move to this slide. As I remember, this was our last slide for the week. What are the monetary policy directions that a central bank can apply in the economy? We discussed two types of directions. One is expansionary monetary policy. The other one is contractionary monetary policy. Expansionary policies are helpful to boost the economy. When you have low inflation, low economic growth, if you want to give some support to the economy, you can promote expansionary policies. And how do you perform these expansionary policies? Either you can inject more money to the economy or you can lower the interest rates by doing that. Contractionary monetary policy is the opposite. When you have some inflation risk in the economy, how do you observe there are inflation risk in the economy? One, economy is growing at a faster rate, which means we call it overheating. So when overheating is there, there is a high risk of inflation because people are having more money, demand can be going up, as a result prices would be going up. So in such situations, central banks are very careful and they are trying to cool down the economy. Cool down means you trying to control inflation. For that matter, you can apply contractionary monetary policy. By name, contractionary means you either increase interest rates or reduce the money supply. Okay. And the outcomes of these policies I have been given in this slide. When you have the tight policy, what you can see, as I said, interest rates are going up, money growth, liquidity is going down, low money growth. And as a result, you will see people are demanding less because demanding less now it's costly for them to borrow and make activities or conduct activities is costly because interest rates are higher. So when you have decline in demand, you call it aggregate demand in economics. When you notice aggregate demand declining, inflation will also be declining because price pressures will be less. When you have relaxed so expansionary policy, you will see interest rates are decreasing and money growth is increasing, which means you have high excess liquidity in the economy. And as a result, you will see demand is picking up. People demand more now because interest rates are low, money is available in the economy in excess. So people will demand now. As a result, inflation is going up, prices are picking up. So expansionary policy outcome is inflation. Tight monetary policy outcome is low inflation or decline in inflation. Both policies can be applied by a central bank depending on the situation. Now, for example, I have given you this question. What is the current monetary policy stance of the central bank? What do you think? Let me see your views, answers. What is the current monetary policy stance of the central bank? I told you, I think, to read the annual report, chapter 7. And if you have read, you might have some idea. Or if you follow what's happening in the economy, you might have some idea. What is the current monetary policy direction we have in Sri Lanka? Yes, I see some answers. Achala says expansionary monetary policy. Netmi says relaxed monetary policy. Achala, would you like to elaborate on your answer? Why do you say that? Netmi, would you like to elaborate on that? Any view on that? Why do you say it's expansionary or relaxed? Or do you have any other answers, other people? Yes, interest rates are low now. Yes, Achala. Any other reason? What do you think? Others? Basically, as you say very clearly, Achala, interest rates are low in the economy. If you look at market interest rates, most rates are actually below 10%, one digit level. So why these low interest rates are there? To boost the economic activity. Why you can allow some boost in the economic activity? Because right now in our economy, inflation threat is low. Inflationary pressures are low. No substantial pressures on the prices. So as a result, most of the conditions in the economy, we can use relaxed policy. Yes, Netmi also says a good answer. Keep midterm inflation at a single digit. Yeah, that is also correct. Now, if you have expansionary policy now, that will help inflation to basically maintain within a kind of a mid target. Because if you have restrictive policy now, inflation could further go down. And on the other hand, as Achala says, we have to promote economic growth because our growth is at low levels, even negative last year because of the COVID impact. And as a result, we have to give some support to the economy. We can give that support because inflation pressures are low. So central bank has kept interest rates low because they can support economic growth while maintaining inflation in their uh, expected levels. I'll come back to that point in a while, but I'm happy most of you have some clear understanding on the current situation. Let's move to next slide. Impact of monetary policy. We call it transmission. This word is important. You might hear this word time to time in your environment. Transmission of monetary policy actions, which means any change of the central bank action, for example, changing in interest rate, that will lead to have some impact on other variables of the economy, especially interest rates, and also that interest rates will affect deposits of the economy and lending and finally inflation in the economy. So from monetary policy action, which means change in the monetary policy, ultimate objective is to have an impact on inflation. This is a long process. That entire process, you call it transmission. So during this transmission process, most of the things happen, which means now you change your monetary policy today, you can't expect inflation to respond tomorrow. There is a time lag. There are certain steps to be passed. So what are these steps? When the central bank change any policy, it will have an impact on the market. Market means market interest rates will be having some impact. If monetary policy is tightened or relaxed, market interest rates. So if monetary policy is increased, rate is increased, which means tightening, market rates will go up. Market rates means what do you have in the banks? What do you have in financial markets? Interest rates. Those will be reduced. Sorry, increased because of we have increased the policy rates. As a result, what will happen? People will now demand less credit because borrowing is now costly. When you have high borrowing cost, you don't borrow. You will wait and see until the next low interest rate cycle comes. So unessential borrowings you will be reducing. So overall, demand for credit goes down. When demand for credit goes down, we know credit is the key component of money, and as a result, money supply will go down. Liquidity will be reduced. When people don't have enough money in their hands, demand pressures will go down and the prices will go down. So that's why ultimately inflation goes down. This is not a simple thing, and people call it a black box. Black box means you don't know what really happens in this process, but we can assume it happens in this way. Or there could be some other way. There could be different channels of this transmission. But it happens. That's why when the central bank takes an action after some time, inflation responds, okay, through the transmission. So this impact is felt by financial market prices. That is also important for us, not only inflation. Financial market prices are also affected, are also influenced. What are these prices? In the financial market, we have two types of markets basically, bond market and share market. Bond market means you basically trade securities which are having some coupon or some fixed maturity. For example, treasury bonds. With the monetary policy change, this market will be affected because if you increase interest rates, bond interest rates will also go up. When bond interest rates are going up, there is a relationship between the bond interest rate and price. What is the relationship? When interest rates are going up, prices are declining. So for bonds, there is a negative relationship with the interest rate and the price. Invert relationship. Negative relationship. So increasing interest rates means reducing prices means sometimes that reduction in prices is not good for the investor. He'll be affected. Then we have the impact on the share prices. Share market is also an important market in the economy. Through monetary policy changes, share prices can also be affected. For example, I told you when interest rates are rising, bond prices are reducing. So people don't like to buy bonds. They don't like to invest in bonds. So people would shift to share market. In the share market, they are requesting or they are demanding more shares now. So what can happen? Share market will be expanding or there can be boom because people now demand more shares. Buying more shares means demand is more, means share prices go up. So what I wanted to tell you, monetary policy change is having an impact not only on the credit market, in the broad financial market as well. Bond prices, share markets. Now, if you move further, you will see there will be an impact on real estates, other type of investments. So all prices or each and every prices in the economy will be affected through a monetary policy change. That entire thing we call it transmission. For that there are various channels, as I said. Now let's move to monetary policy conduct in Sri Lanka. So this is the most important part for us in our paper. We have questions mainly related to Sri Lanka. Some broad questions are also there, but mainly it's related to Sri Lankan context. Okay. Any questions before we move to this part? No? You are there? Students, are you there? You can hear me?
Yes, sir, we can.
All right, okay. So you don't have any questions, we can move, no?
Yeah, sir.
Okay, great. Now, in Sri Lanka, monetary policy is basically conducted by the central bank. Central bank is basically is in charge of monetary policy. In most of the countries, actually, the central banks are the major entities that conduct monetary policy. I think in the case of 99.9%, it's the situation. Mainly, the central bank is conducting the monetary policy. So in countries, it's very clearly divided. The role of the central bank and the government. That's why we have this clear identification that central bank is in charge of monetary policy. So in the case of Sri Lanka also is the same, where central bank is playing a major role in the economy by way of conducting the monetary policy. Now, if you look at the central bank's role, it has two major objectives to be achieved in Sri Lanka: maintaining economic and price stability and maintaining financial system stability. We will have a broad discussion, I think, deep discussion on the central bank in another week, because that's one of the key financial institutions in the economy. So we are going to have a thorough discussion on that. But very briefly here at this moment, if you look at the objectives of the central bank, it attempts to achieve two, basically: economic and price stability, financial system stability. Economic and price stability, by name you can understand, we have to have some stability in the economy. We have to have some stability in the prices. I hope you remember stability means less volatility, no major increases or decreases or downturns. You're trying to maintain some smooth cycle in the economy. So that's one objective. The other, financial system. The central bank is trying to have a stable financial system without having any major problems. No collapsing banks, no system failures, payment system is secured, likewise, stable financial system. Now, in regards to economic and price stability, where the central bank is playing a major role, you can link monetary policy to that aspect. In other words, central banks achieves economic and price stability through conducting monetary policy. So you can see, to achieve the objective of the central bank, one of the objectives, which is price stability, it uses monetary policy. As you already know, monetary policy is the process which controls by the central bank to influence the cost and availability of money. So central bank is doing this. Now, when the central bank is conducting monetary policy, we have to look at in what framework. Now, in Sri Lanka, central bank is conducting monetary policy in line with this framework, flexible inflation targeting framework. So if someone asks, what is the central bank's monetary policy framework? Framework means in which system. What we have is a FIT. FIT means flexible inflation targeting framework. There we look at two variables: inflation, growth. I think when you are answering, some of you given answers based on inflation. Some of you also gave answers by looking at growth. So central bank is looking at these two variables right now, trying to stabilize inflation. First, stabilize inflation means to reduce volatility and keep inflation at a low level. What is this low level? Mid-single digit. Usually mid-single digit means 5%, right? Usually, not usually, it's the fact, 5%. Mid-single means 5%. How it is, it becomes 5%. Central bank has a kind of a, if you look at this chart, a broad target to be maintained. Right now, central bank's broad target is 4 to 6%. So within this 4 to 6%, central bank is trying to keep inflation. Now, if you look at this chart, you will see some shaded area, blue color area. That blue color area is the 4 to 6% area. Central bank is trying to keep inflation within that 4 to 6% area. Ideally, at 5%, which means the mid-single digit, closer to this point. Now, if you look at this chart, you will see that blue line, blue shaded area is the inflation target band. This red line and the yellow line are the actual inflation rates. Actual inflation rates given by CCPI and CPI. I discussed this no last week. Colombo Consumer Price Index, National Consumer Price Index. Both are measuring headline inflation, which means overall inflation. So overall inflation, if you look at this chart, has been basically low in the sense it's less than 10%. Most of the time, central bank has been able to keep that in that range. What is the range? 4 to 6%. So this part 4 to 6%, this part 4 to 6%. Sorry, even here it's 4 to 6%. This part 4 to 6%. There are some deviations also. Here you can see some deviation. Here you can see some deviation. Here you have deviation. You have deviation here. Role of the central bank is to keep inflation within this target range. That's why you call it stabilizing inflation. So while central bank is doing this, it also looks at economic growth. What happens to growth? Whether growth is going very low, very high, or it is volatile. Central bank is also considering that. By looking at that two variables, inflation and growth, central bank will be changing its focus. Now these days, as you said, we have low economic growth and low inflation as well. So central bank can focus on growth right now to give some support to growth. Okay. So the message here is central bank right now having a flexible inflation targeting framework, which means inflation targeting means you target a 4 to 6% inflation. 4 to 6% inflation. Why it is flexible? Not only inflation, you can also look at economic growth as well. That's why. If it is strict inflation targeting, you only look at inflation only. Now, in most countries in modern world, they have this flexible mechanism. Depending on the situation, you change the focus into inflation or growth. How does the central bank keep this target to achieve this? You already know it through monetary policy, through its monetary policy instruments. And by using those instruments, central bank is trying to achieve the target by way of impacting one important variable in the economy. This variable is very important for you because it's a financial market variable. What is this variable? Average weighted cold money rate, AWCMR. This AWCMR is under direct control of the central bank. By definition, this is the average weighted of all transactions in the coal money market. Coal money market is overnight market, which banks are buying and selling money for their day-to-day needs. Banks need money, day-to-day basis. For that matter, they borrow in this coal market or lend in this coal market. Coal market means it's a very straightforward market for loans. No securities involved. People only borrow based on trust. The security is not pledged. They borrow today, maybe they settle tomorrow or maybe in 7 days. But it's a very short-term market to fulfill the funding needs in the short run. So this AWCMR, we call it operating target of the central bank. Operating target. So you see the word operating target, and I remember there was one question on this. What is the current operating target of the central bank? So in the case of Sri Lanka, operating target is the AWCMR. Okay, which means central bank has a direct control to influence the inflation. So let's look at what are the key tools that the central bank is having right now. In this slide, there is a summary of all the tools, key tools that we use. Open market operations and policy rates, reserve requirements, moral suasion, and other instruments like bank rate, quantitative restrictions on credit, ceilings on interest rate, foreign exchange operations. These are other tools. This one is the major tool used by the central bank, OMO and policy interest rates. So let's start with OMO and interest rates. OMO, you already know, central bank is conducting OMO to absorb or inject liquidity. Absorb or inject liquidity means either to inject money to the economy or absorb money from the economy. Okay? So when the central bank is conducting this OMO, injecting or absorbing money, how it happens? Remember, we exchange securities. Right? Central bank is giving securities, absorbing rupees. Or central bank is giving rupees or buying securities or injecting rupees. This is the process we call as open market operations. In conducting open market operations in the central bank, there are some, elements. One is the interest rate corridor. I'll be discussing in the next slide. To do this, we have daily auctions at the central bank. Auctioning what? Auctioning money. Then we have a system called a standing facility. Standing facility means if you are failed in the auction, you can come to this standing facility, which means a kind of a window to borrow or deposit money at the end of the day. So let's look at this interest rates corridor. It is important. Interest rate corridor, we call it standing rate corridor, which means upper bound and the lower bound of the policy rates. So in Sri Lanka, the lower bound of the policy rate, we call it standing deposit facility rate, SDFR. Now these two words are important. Every paper I see questions related to this. Right now, the lower bound, we call it as the standing deposit facility rate. If you look at this chart, there is a shaded area again. This shaded area, not inflation, right? If you look at this key, you will see it is SRC. SRC is what? Standing rate corridor. So it's like a passage. Interest rates are moving within this passage. So this passage lower bound is the SDFR. So in this passage, if you mark the lower bound, you call it SDFR, stand-in deposit facility rate. What is SDFR? Here is the definition. Write it down. SDFR or stand-in deposit facility rate is the rate that the commercial banks deposit excess money with the central bank. Rate that the commercial bank deposit excess money with the central bank. In a particular day, if the commercial banks are having excess money, usually they come to the auction and try to deposit. But I told you in the previous slide, if there is a failure in the auction, this is the other option they have. They can come to the stand-in deposit facility window and deposit that excess money with the central bank. So when they are depositing, when they are depositing, the rate that they receive, interest rate, is the stand-in deposit facility rate. That's why I define it as the rate at which this commercial bank deposit excess money with the central bank. It is identified by the lower bound of the policy rate corridor. Then the upper bound. In this chart, in this shaded area, you have an upper bound also. That upper bound, you call it SLFR, which means standing lending facility rate. Earlier this we call it as reverse repurchase rate. Now normally we don't use this repurchase and reverse repurchase rates terms, but I just included them because in some countries we have these terms. In Sri Lanka we don't use it now. We use standing lending facility rate as the upper bound. What is the definition? Here's the definition. Write it down. Standing lending facility rate is the rate that the commercial banks borrow money when they need funds. Standing lending facility rate is the rate that the commercial banks borrow money when they need funds. Sometimes commercial banks might have some shortage of money. They want to have some money to fulfill their requirements. They try to find it from the market. If they are unable to find it from the market, they come to the auction of the central bank. If they could not succeed at the auction, they can come to this window, standing lending facility window, at the end of the day and borrow at that window. So when they borrow, the rate charged from them is the standing lending facility rate. Now by definition, you know how this borrowing is happening. You give the securities to the central bank and take money. So it's a repurchase agreement, remember. Giving securities and buying money. So it happens at the upper bound of the corridor standing lending facility rate. Now these rates are reviewed time to time by the central bank and change it. When central bank wants to increase the interest rates in the economy, it increases this corridor. If you look at this chart, there are some periods where the corridor has been increased. I don't think you can see it from this chart because in some areas, some lines are overlapping. But if you look at this part, you will see some, changes in the interest rates upward. If you take this part, you will see interest rates are actually reducing because downward adjustments are there. So all in all, time to time, central bank can change these rates as they want based on the needs of the economy. Okay. So regularly, these are reviewed by the central bank and changed. Now I have a question. What is the rate right now? SDFR and SLFR. Because I asked these questions, this is in your exam paper. What are the current rates? Hmm? Lower bound and the upper bound. Any answer? Can you, I mean, without typing, can you give a kind of voice answer? Because I can't see the chat. What are the current rates?
4.
4 is what? We have two ranges. Lower bound, this is the lower bound.
SLFR?
SDFR is the lower bound. I'm asking what is the percentage? Somebody said it's 4%.
It is 2% SDFR.
No,
0.5 and 5.5.
exactly. 4.5 is the lower bound. Upper bound SLFR is 5.5. This upper bound is 5.5. So there is a gap like 1% between two. 1% gap is there. Lower bound 4.5, upper bound 5.5. Now these numbers are important because you have some short answer questions on these numbers. And be aware, time to time central bank is changing these numbers. You have to know what are the current numbers. So my wish, before your exam, central banks change these rates and you should know what are those new rates. So be attentive, which means you have to follow the central bank actions and monetary policy news. Okay. So this is the standing rate corridor, SRC, used by the central bank to indicate its monetary policy stance and to change the monetary policy direction as they want. As I said, if they want to tighten the monetary policy, they will increase both the rates. If they want to relax the monetary policy, they will reduce both the rates. And these rates are having an impact on the market rates as well. The reason is these are the benchmark rates. Commercial banks borrow or lend at these are the lowest rates. And based on that, they will price their interest rates, market rates. Okay. In this chart, there are some other variables also. I will explain those variables, and I think even in the next few slides, we have some reference to this slide. But before we move to that, I'll explain those other lines as well. There's a red line within the corridor. Can you see? That red line is the AWCMR. I told you central bank is controlling AWCMR, which means the operating target of the central bank. What do you mean by AWCMR? Average weighted call money rate. This rate is the commercial banks are buying and or selling money in the short-term market, which means commercial banks are borrowing and lending in this market in the short run to fulfill their funding needs.
Sir,
Yes?
according to the chart, SDFR should be 2%, no, sir.
Why?
In 2021?
No, that yellow line, right?
Yes.
What is yellow line? If you read the chart carefully, here if you look at the key, what is yellow line? Can you see it? Yellow line is what?
Statutory reserve ratio.
Exactly. It is SRR, statutory reserve ratio, not the SDFR. Now in this chart, SDFR and SLFR are marked in the shaded area, like a shaded area. So if you want to write it very clear, you can write it. I don't know whether you have the print with you. But in the shaded area, the lower bound is the SDFR. Upper bound is the SLFR. Maybe I'll show you in a blank slide, then you will be very clear. Okay. So other than that, there are two other lines. The yellow line, somebody told it's statutory reserve ratio very correctly. Another instrument, statutory reserve ratio, currently it's around 2%, at 2%. Okay. And there's another line, did you see a thick blue line? You call it, if you look at the key, bank rate. Bank rate is also a monetary policy instrument used by the central bank to give loans to the banks when they are in a difficult situation. Now this, here in this area, it's not a difficult situation. In this area, normal operations. If they have a shortage on a particular day, they can use this SLFR rate. But if they are having a funding issue for a long term, they have some, panic in their bank, they need money and no one is giving money. At that time, they can borrow from the central bank at a particular higher rate. You call it bank rate. So for many years, bank rate was 15% fixed. Now last year during COVID year, these rates have been reduced. Now the bank rate is actually fixed to the SLFR, which means now it's changing when the SLFR changes. As I said, let me take a blank slide, then I can explain it. Can you see my blank slide?
Yes, sir.
Yes. Okay. So these are the interest rates. So the upper bound of the policy rate corridor and the lower bound of the policy rate corridor. Lower bound is the standing deposit facility rate. Upper bound of the policy rate corridor is the standing lending facility rate. Okay. Deposit facility rate is the rate that the commercial bank deposit excess money Lending facility rate is the rate that the commercial banks pay to the central bank when they borrow money. So this is the corridor, SRC. Now there is a gap of 1% between SRC. Right now the lower bound is 4.5 and the upper bound is 5.5. Okay. If the central bank want to change the monetary policy, it can change this entire corridor. Let's say they want to reduce it further. So you can bring down the corridor. Clear? And then I told you coal money rate is basically moving within this rate. Likewise. So the blue line is the AWCMR, which is the average weighted coal money rate, where banks are borrowing and lending in the coal market, short-term money market. And there's another interest rate which is above all these rates, that is called as the bank rate. Bank rate, that is the rate that the commercial banks borrow from the central bank when they are in a distress situation, emergency situation. So in some countries they call it emergency facility rate. Right now it's fixed to SLFR. So SLFR plus 3 percentage points right now. So what is the rate now in that sense? 8.5. So SLFR, if you change, this bank rate would change automatically. Clear? Any questions? Hello? Any questions? I hope it's clear now. Okay, the corridor. So open market operations, the main instrument, I told you, they are conducted either to absorb liquidity or inject liquidity. Absorb means when there is excess money, you can take them in. If there is shortage of money, you can inject money. So if you look at this chart on the right hand side, you will see there are some periods with large amounts of liquidity, positive. There are some periods of less amount of liquidity, negative. So this is negative liquidity. This is positive liquidity. Usually when there is positive liquidity, central bank is absorbing. When there is negative liquidity, central bank is injecting. Why do you need to inject or absorb liquidity? In order to keep the stability of interest rates. So this interest rate line, if you look at the red line, you can see to keep interest rate stable or at least to have some, gradual adjustment, you have to have liquidity provided in the economy. So if the central bank does not provide or absorb liquidity like this, interest rates could be heavily volatile like this, right? If you look at this chart, this red line is not that volatile. It's, going up and down, but at a stable rate, stable way. In this chart, you will see there are a lot of names given: long-term options, short-term options, overnight options. These are actually the facilities provided by the central bank to absorb or inject money. And there are two other terms, stand-in deposit facility and stand-in lending facility. Now you know what are those two are. Those are the rates at the central bank, commercial banks are depositing money or borrowing money, and the facilities given in this chart. Okay. So here I have given you a definition for stand-in facilities are available for those participating institutions, which means banks, which were unable to obtain their liquidity requirements at the auctions. If they fail at the auction, they can come to this stand-in facility. Next, reserve ratio. I think you already know the definition of reserve ratio. In Sri Lanka, reserve ratio is referred to as statutory reserve ratio, SRR. So this is the proportion of deposit liabilities of commercial banks with the central bank kept in cash. Right? Deposit liabilities means central banks, commercial banks are having various deposit liabilities, demand deposits, time deposits, savings deposits. In rupee, right? We don't take foreign currency, SRR. All commercial banks are having these rupee deposits, either demand, time, or savings, or all. Mainly all. So out of these all deposits, they should keep a deposit at the central bank. You call it SRR. Now it is actually at 2%, as someone said. From each and every deposit, commercial bank should keep 2% at the central bank. And we know if the central bank changes this rate, what can happen? Money multiplier will change. Okay. Other instruments I am not going to discuss in detail. One instrument I already mentioned here, the bank rate. Okay, that is also policy rate. So other than this reserve ratio, central bank is using foreign currency transactions to inject or absorb rupee. Sometimes central bank impose ceilings saying you can't expand money supply more than this, you can't give credit more than this, you can't increase or decrease interest rates more than this. Those are administrative tools used by the central bank. Sometimes central bank use moral suasion. Moral suasion means they have a discussion with commercial banks, to advise commercial banks. Okay, you have to do like this, do like that. Likewise, some indication is given to commercial banks on the central bank's intention to central bank's intention of its outcomes. What type of outcome they expect central bank, according to that intention, the commercial banks are required to adjust their behavior. Call it moral suasion. So after doing all these things, all these monetary policy actions, when they decide it, central banks need to communicate it. Communication is one of the key actions of a central bank. Under communication, they disseminate the policy decisions to the economy. They do it with a clear purpose to manage expectations, specifically containing inflation expectations. Inflation expectations means what people think about inflation. Whether inflation is going up or going down, their understanding or their expectation about the future. If people think inflation is going up in the future, their behavior will be different. If people are assured that inflation is not going to go up in the future, their behavior would be different. So that behavior is defined based on the central bank's actions, either to inflation to be contained in the future or not. That matters for the public. That expectation management is done through the communication. So in communicating, central banks are using various approaches. You can talk, you can do an interview, you can put a notice, you can have a press conference, you can write a report, you can make presentations. Nowadays, you can tweet, Facebook, SMS messages, live streaming of a kind of a discussion or whatever. There are a lot of methods that the central bank can follow. Among these, I would say the most important thing is the press release of monetary policy. In Sri Lanka, right now, the central bank is publishing 8 monetary policy press releases per year. So this press release is really important. That gives some key information. So in the press release, central bank will say whether they have changed the interest rates or not. In particular, whether they have changed the SDFR or SLFR. That's clearly mentioned in the press release. And also, very importantly, central bank gives rationale for that decision. That is the important part. We can understand why the central bank has arrived at that decision. There are some economic variables, as we have already seen, mainly inflation and growth. They look at those two. And based on these, the central bank will take a decision, and that decision is clearly highlighted in a simple language in this press release, and the rationale is given, reasons are given to support that decision in a similar language. So my recommendation to you, it's really important you look at this press release. Every time it issued, you have to read it. Not only for the exam, but even as a financial market player, stakeholder, an expert, or a professional in the financial system, you have to look at this press release very seriously when it is issued. Okay. So the next press release of the central bank will be issued on 19th August this month. Now today is 8th. In 2 weeks' time, less than in 2 weeks' time, this will be published by the central bank. Early in the morning, 7:30 in the morning. If you browse the central bank website, www.cbsl.gov.lk. Right? This is the website. If you browse this, you will find the press release. on 19th August at 7:30 a.m. This is also available in the Facebook, other media, even in the newspapers. This will be published. And also there will be a press conference attended by the governor. He will give you a clear understanding why the central bank has, if they have changed the policy, what are the reasons, and why they have not changed, even that will be explained. Okay, so this is important. You have to read it, and that press release will give you the answer for one of the questions. What are the current policy rates of the central bank? Okay. So I plan to have a discussion on this press release in the class also, but you have to read it and come back in 2 weeks' time. Because we need to understand this press release. This is really important stuff. Okay. So we already discussed, answered some of you answers about the current monetary policy stance of the central bank. Here we have a summary. The current monetary policy stance is, as you said, is a relax. We have a relaxed monetary policy right now. Relax or expansionary. So here we have the reasons. The economic downturn resulting from the spread of COVID-19 and the related containment measure necessitated the unprecedented easing of monetary policy. Monetary policy is relaxed and expansionary, and it is unprecedented. Unprecedented means this is something more extraordinary. Why do you say like that? Policy rates have been reduced substantially, 200 basis points, 250 basis points, which means 2.5%. It's a large reduction of interest rates. SRR reduced by 300 basis points, which means by 3%. Now SRR 2% means it came down from 5%. It's a large reduction. Bank rate 650 basis points, which means 6.5% reduction. 100 basis points equal 1%, right? That's how you have to read it. Basis points means 100 basis points equal 1%. 100 BPS basis points equal 1 percentage points. So likewise, these have been reduced notably. Policy rates, SRR, bank rates have been reduced. And other than that, central bank has imposed interest rate caps. As I said, interest rate caps have been introduced for ODs, for credit cards, for pawning, for loans. Likewise, there are some caps have been introduced. Concessional loan schemes have been introduced by the central bank. Concessional means borrowing at low rates. Most of these concessional schemes have 4% interest rates during the last year and this year. And also some for housing, there is a 7% interest rate. So a lot of monetary policy easing have been introduced. Okay. And also other than that, liquidity in the economy. Liquidity means money in the economy is having a large excess. If you look at this lower chart, you will see excess money in the economy is over 200 billion during last year, and most of the time this year it has been in a huge excess. right? So what are the outcomes of this expansionary monetary policy? You see, interest rates are reducing. Now, there are various interest rates given in this slide. I'll be defining these interest rates in our next session. AWPR, AWDR, LR, all these are interest rates in the economy. You will see all these interest rates are in a downward trend. As a result, what will happen? What's happening? Credit is increasing. Credit is increasing. And then inflation rate is basically under control. There's no large increases in inflation. Only food inflation is basically showing some increases because food prices are higher. But other than that, if you look at these two lines, headline inflation and non-food inflation. Non-food inflation means basically indication of core inflation. All these inflation rates are low. We know why it is happening because we need to give some support to the economy during this crisis period. Okay. I hope you are clear about the monetary policy and related developments in the economy. So here we have some questions related to this monetary policy. Now I ask you what are the interest rates in the economy. There will be questions: standing deposit rate, and what is the importance of this rate. Likewise, there are some questions, and also I told you the level of rate is also a question. Now in this question 2015, what is this DF rate right now? Likewise. So there are questions in every paper related to monetary policy. Here we have statutory reserve ratio, central bank reverse repo rate. Central bank reverse repo rate means SLFR. I told you. So multiplier, remember if the SRR is this percent, how much is the multiplier? We have a simple equation for that, 1 divided by RR, remember, reserve ratio. And I told you not some directly related questions, some, some indirect questions, right? So for example, if the central bank has done some changes, what will be the impact of these changes to the economy? If reserve ratio is increased, what will happen? If policy rates are increased, what will happen? So those are some indirect type of questions. Why do central banks conduct monetary policy? I told you to control inflation. What are the instruments? We already know. Policy rates, OMO, bank rate, SRR, other instruments. There are various instruments. What is meant by open market operations? I think you remember I told you injecting and absorbing money from the economy by selling or buying securities with the commercial banks. So here we have some, interest rate related questions. Low average weighted prime lending rate. I'll be discussing them in the next session. Policy rates of the central bank. We already covered SLFR, SDFR. Those are the key policy rates. If someone writes bank rate, that is also fine. That is also kind of a policy rates. So here again, I told you some indirect questions. You write some short notes highlighting the importance. Why stable and low inflation is important. Why interest rates are important. Central bank rates to commercial banks. Central Bank of Sri Lanka monetary policy review announcement. I told you why it is important. So I think these are very similar questions. Now this question briefly discuss the lender of last resort function of the central bank. This is related to central banking. I think we will discuss next week in a detailed manner. But what is this rate actually? Lender of last resort rate. I told you bank rate. Bank rate is the rate used when there is a distress situation of a commercial bank. You call it last resort rate. Here in this question, what is the applicable interest rate when a licensed bank borrow from the central bank? When a licensed bank comes to a central bank and borrow, what is the applicable rate? Overnight rate. We discuss. SLFR, standing lending facility rate. This is from the latest paper, briefly discuss the open market operations. I think you have some idea. I discuss them as the buying and selling securities by the central bank. Bank rate we discussed, that is the rate charged from the banks when they are in a distress situation. They can borrow from the central bank. SRR we discussed, the proportion kept at the central bank by commercial banks, right? So this is very easy way of answering because we already know every question we have covered in our discussion. Okay, any questions? Related to this part? Any question? No. Does anyone want to ask? Now I see some of you have joined later. Obviously, I can't repeat what I have said earlier, but if you have any question, this is the time that you can get some clarification before I move to the next part. Right. What is our plan right now? Since we started at 7, we have some space today because I can go beyond 9 o'clock, and IBSL also requested me to utilize some time because in our timetable, I was told we have some, some tightness in the timetable in terms of the exam timing. Because of this A level is scheduled to be held in November, so we have to have some, early finish to our discussions. So according to our time plan, so as a result, we have some, tightness in our timetable. So whenever it's possible, we use some extra time. So today I can use some extra time because we started early to cover up some of the materials that we already supposed to, or we are supposed to do today. So since we will be having the class even beyond 9 o'clock for some time, we would take a break right now, 10 minutes break, and join in 10 minutes time. And I'm planning to basically, discuss interest rate handout as much as possible. So it is a very simple handout. Let's try to, cover as much as possible. Is it okay with you? Right? It seems no issue. Shall we take a break of 10 minutes? Now it is 8:35. Let's come back by 8:45, right? Somebody has sent a message. If you don't mind, can you share the previous slides once again? What do you mean by that? Sharing previous slides means I have already, I think, shared all these slideshows with you up to now. So it should be available in your LMS. I'm not so sure about your requirement, so please clarify what is really needed. Okay. So shall we start? Are you there, students?
Yes, sir.
Okay, we'll go ahead. Can you see my slides?
Yes, sir.
Okay. So related to monetary policy and also the central bank actions. Now let's move into interest rates. Once we discuss this interest rate, we will be, 100% covering the related discussion to money, monetary policy, and related stuff. So interest rate is what? What is the interest rate? How do you define? It's the price of money. I think I already mentioned to you one day when we were talking about money, we simply define interest rate as a price of money. Why do you say price? It's the price of money. In a financial system, we know money is used for various purposes, especially as a deferred method of payment, which means you borrow using money and later on you settle that borrowed money as a deferred payment. So when you settle that money, you have to pay some rent for the usage of money. So in economics, you call it the opportunity cost of money not being used today. Now, if you have a certain amount of money, without consuming it, you give it to someone as a loan. So when you give it as a loan, it has an opportunity cost. What is the opportunity cost? You could have used that amount of money for some other purpose. So without using money for that some other purpose, you give it as a loan. It incurs an opportunity cost. That opportunity cost has to be compensated. That opportunity cost should have a value. That value is the interest rate or the price paid by the supply of money, price received by the supply of money, the lender, or the price paid by the user of money, that is by the borrower. Lender is receiving a price, borrower is paying a price. That price is interest rate. Now, usually, in theoretical sense, this interest rate is determined through market process. Why do you say market process? No one will determine the rate. Even the central bank does not determine the interest rate. Central bank determines only policy rates. Policy rates means the benchmarks rates. In our case, in Sri Lanka, that standing lending facility rate and deposit facility rate is determined by the central bank. Not any other interest rate. All other interest rates, market interest rates are determined in the market, which means through the supply demand mechanism. So theoretically, this supply demand mechanism is discussed as two theories: demand and supply for bonds. That is one school of theory. So according to this, demand for bonds and demand for supply for bonds will determine the interest rate. That is one theory. The other theory, supply and demand for money determines the interest rate. So according to this, demand for money, MD, and supply for money, MS, will determine the interest rate. So both agree on one thing. Bonds or money, these are financial assets. So supply and demand for financial assets would determine the interest rate. That is the overall conclusion out of this discussion. I'm not going to theory in detail because it's not related to us at this stage. We only need to understand it. So we were talking about supply and demand for bonds or money that determines the interest rate. I hope it's clear. Through the market forces for financial assets will determine the price of money. That was the idea. Why interest rate is important? It is one of the key macro variables in the economy. Macro variables that is important to make very substantially influencing decisions to the economy. What are these influencing decisions to the economy? Savings and investment decisions. Now, savings and investments are the key for economic growth and economic performance of an economy. What is the level of saving that the people will have? And also how much they invest will be basically determined, or allocation of resources. That decision is basically dependent on interest rates. So it's one of the key variables in the economy. And also interest rate is important because it affects the consumer spending. People will change their consumer decisions according to interest rates. In certain time period, there are high interest rates in the economy. So when high interest rates are there, people will not like to spend more. They would like to save because through high interest rates, you can have a higher return. When there are low interest rates, people will basically spend because no point of depositing money in financial institutions, interest rates are low. So in other words, the changes in interest rate will determine the consumer spending behavior. It's important for the central bank. I think this is very important in terms of our discussion. Central bank uses interest rate as a mean for monetary policy. Remember, central bank is changing the interest rates in the economy by changing their policy rates as a method of monetary policy or as a tool of monetary policy to achieve their objectives, that is inflation. Important for the government. Government is also very keen on the interest rate. Why? Governments are basically borrowers or net borrowers, which means they are always dependent on markets to fulfill their funding. Because governments are running deficits, those deficits have to be financed. So when they finance their deficits, they have to borrow from the markets. So when you are borrowing, they have to pay an interest. So as a result, government is also very keen on the interest. They would like to have low interest rate as much as possible. Interest rate is also affecting financial market prices. Markets and prices. As I said earlier, bond markets are affected by interest rate changes. Share markets are affected by interest rate changes. I told you with the bond market and the bond price and the interest rate, there's a negative relationship. Higher the bond interest rate, lower the bond price. On the opposite, interest rates and share market can have a positive relationship, which means when interest rates are going up, share market is picking. Why? People are moving to shares because now the bond prices are low. So likewise, all these markets are affected by the interest rates.
So treasury bills also, can we take it as?
Exactly, yes. When you sell treasury bills in the secondary market, that will have an impact. Normally, when you buy a treasury bill, at the purchase of the treasury bill, you deduct the return, which means your income is already generated when you buy the treasury bill because you buy it at a discount. So owner of the treasury bill owner will not have any impact at the maturity in that sense because he has already received his funds. But if he is selling it in the secondary market, which means before maturing, if he is selling to someone, then the interest rate matters because the price will be dependent on that interest rate. Clear?
Yes, thank you, sir.
Okay. Let's move on to different concepts of interest rates. Now, interest rates, when I say it's simply, as I said, price for money. Now, based on that simple definition, we can identify various types of interest rates. First one is simple interest rate. Then we have the compounded interest rate, or we call it effective interest rate. That is one set of interest rate. The other set is the nominal and real interest rates. Okay. So let's look at these concepts in a detailed manner. Simple interest rate is what? I think you already know simple rate, that is calculated based on the principal value. If it is a loan, based on the principal. Principal means what is the original amount. If it is a deposit, based on the deposit, you calculate the principal value. There's no compounding. Compounding means there's no interest on interest. In other words, depositor will only gain interest on the principal. Principal is, let's say, 1,000. Based on that 1,000, you get a certain percentage of interest. Let's say 1,000 into, now interest rate is 5%. Let's say you get 5% as the simple interest rate. If it is a loan, borrower will have to pay on the principal. No interest on interest. Again, if you have borrowed 1,000, you only pay 5% for this 1,000. So it's an easy way of calculating interest rate. That's why you call it simple interest rate. Here we have the example. Simple interest rate is the principal balance calculated by the interest rate. As I said, if your principal balance is 1,000, interest rate is 5%, your simple interest rate is what? 50, right? It's very straightforward. Compound interest is a bit different. There you have to consider interest rate earned or paid over the period. Now, why this is important? People will not keep money in banks or financial institutions if they don't get compound interest. People will not lend, financial institutions will not lend if they don't get a compound interest rate for their lending. If it is only 1 year, they might not worry because in a 1 year period, it's done. But if it is going over the period, for example, let's say going to 5 years, then they should have interest on interest or accumulated interest. Now, for example, I have a table here in this right hand side. Let's say interest rate is 10%. your principal value is 10,000, right? So if it is simple interest rate, what will happen? Every year, based on this 10,000, you will get 10% interest rate. So 10,000 into 10% means 1,000. So year 1 you get 1,000, year 2 you get 1,000, year 3 you get 1,000, year 4 you get 1,000. Likewise, you get 1,000 every year. So end of the period, let's say after 10 years, you earn 10,000 out of the simple interest rate. But it's not the case. What happens? If you draw a timeline, usually in the first year, if you get 1,000, normally people don't take this 1,000 out. Interest rate is not taken out normally. Some people, they get it. Some people, they direct the interest to another account for the benefit of someone. But most of the people, they allow that interest rate to be accumulated. So now this 1,000 will be accumulating over the period. Actually, what will happen? Earlier, if you had 10,000 as your deposit, now after 1 year, actually your deposit is not 10,000. Now your deposit is 11,000. Why? You have added this 1,000 interest rate also to your principal. So in that sense, if you look at the last column, you can calculate compound interest rate. So initial deposit 10,000. First year you get interest as 1,000. Second year you get interest as 1,100. Why? Here your deposit will become 11,000. Here your deposit will become 12,100. Why it is growing your initial deposit? Because you are compounding the interest. That interest is added to your principal. So this situation, you call it as interest on interest or compounding interest rate. Probably you may have heard in Sinhala Valpolia. So this is basically Valpolia, what you are receiving interest on interest.
So can you give some example for that?
Let's say you are depositing 1,000 rupees in a bank. Okay.
I mean, fixed deposits. Can we take
FD.
fixed deposit?
Yeah, and FD has a kind of a compounding interest rate.
Another thing, sir, when the customer lose to fail loan, also that we have charged, that also coming under this.
Yes, exactly.
And late payment fee for the credit card.
Exactly, same.
Oh, okay, thank you, sir.
Interest on interest. So that's why you have to be very careful. A good example is, as you said, a loan. If you do not pay the installment, what will happen? That part will also be added to your loan, and interest will be charged on that new amount. Classic case is the credit card. You're right. So I hope it's clear. So how do you calculate it? This compounding interest rate. So we have a very simple formula: P prime into P into 1 plus R divided by N multiplied by NT. What is P prime? Is the new principal amount, right? How do you calculate the new principal? P is the original principal. 1 is basically a constant, it doesn't change. R means your nominal annual interest rate. In this case, let's say R is 10%. P is 1,000. Divided by N means for how many periods? That period will determine or change based on your agreement. If it is annual thing, your period will be number of annual years, right? So n will be basically decided by the frequency of compounding. If it is actually monthly, this n will become 12. Compounding monthly. If it is quarterly, this n will become 4 every quarter. If it is biannual, this n will become 2. So this is the frequency of compounding. T is the overall period, whether it is 5 years, 10 years, likewise. So you can use this formula if you are required to calculate the principal. I haven't seen in your exam this, calculation is given as an exam question. So in my view, you don't need to worry that much of worry you don't need to have, because no calculations are there in terms of this compounding interest rate. But you should know the concept. That is the idea. Okay. This compounding leads to another idea of effective interest rate. Compounding is basically accruing. In accounting terms, it is accruing. So this accruing is related to the idea of effective annual interest rate, EAR. What is EAR? It is the actually earned or paid on an investment or a loan or whatever due to compounding over a period of time. It is annual equivalent rate. For example, simple interest rate is 10%. Okay. If there is monthly compounding, what is the EAR for this 10%? If this 10% in compounding monthly, what would be the equivalent rate in 1 year's time? So it could be basically, let's say 10.3. What you can see through the compounding, your annual equivalent rate naturally becomes higher. So here I have given you a very simple equation again to calculate effective annual interest rate. 1 plus in divided by n into minus 1. Again, this I means nominal interest rate. It could be ROI, whatever. It's the nominal interest rate. N is simply the compounding periods. Okay. Same idea presented in a different way. Now here they have, in the book I extracted, they have used here I, not I, R. If you get confused, you can use it I. You use as I. Here also you can change it as I. Nominal interest rate. So here I is simply the nominal interest rate. Let's cut R, then you will be very clear. So this effective interest rate idea is very important when you select between different options of investments. Now here I have an example. Let's say if an investment A is paying you 10% compounded monthly, right? An investment B is also similar investment, but you get 10.1 compounded semi-annually. So which one is better? Investment A or B? How do you decide? You have to calculate the effective annual rate and see which one is very important. So let's take investment A. How do you calculate effective interest rate? Using this formula. 1 plus 10% divided by 12. 12 means number of months. power into 12 minus 1. So this part is actually plugging numbers to this formula. What is the answer you get? 10.47. 10.47 is investment A. Remember, it's compounded monthly. Second option, investment B, you compounded semi-annually. Semi-annually means only 2 times per year. So here now N becomes 2. I told you if it is quarterly, it will become 4. So through this semi-annual compounding, what is the amount you get? 10.36 semi-annual. So by looking at these two options, you will see A is much better. Why? You are getting 10.47 as against 10.36. What is your conclusion based on this answer? As long as you compound more, your return is much higher. If this is compounded daily, what will happen? Your interest rate will be much higher. So there is a famous, story. Probably you may have heard these Swiss banks, and there is a tendency people they like to invest in Swiss bank, deposit money in Swiss banks. Somebody told me the reason why people would like to deposit money in Swiss bank, because it's daily compounding, not monthly, not half yearly, not annually. Every day you keep money, it is compounding. So this part, this 12 or 2, which means N becomes 365. On a daily basis, it's compounding. So you get more return. I don't know whether it's true or not, but some, rumor. Even the rumor has a kind of a lesson for us. What is the lesson? More compounding means high return. Okay. So let's say you are depositing money at a bank. You might be deciding this, whether you are going for a monthly rollover, monthly compounding, or you go for 3 years. Sorry, 3 months. Which one is much beneficial? You can decide. Now to do this, I'll tell you a shortcut. In every bank, nowadays in every bank's website, they have a calculator for deposits and loans. So you can try and see, put 1,000 rupees and see if you deposit for 3 months, how much you get. If you deposit for 1 year, how much you get, and see which one is much beneficial. You can do your homework on your own and decide. Earlier, the bank officer will calculate and tell you, okay, if you deposit for this period, you will get only this. If you deposit for this much, this period, you will get this amount, right? So that idea is become effective, is based on effective interest. Now, when banks are publishing their notices, especially on deposits, you might see in a advertisement, you might say, okay, we pay 12% per annum. Per annum means per year. And within brackets, they would say 12.38 effective. What does that mean? Even though you agree for 12%, you get 12.38 if you compound. Compound means you keep money for an extended period and allow compounding. Okay. Then the other set of equations I told you, nominal and real rates. Nominal means what is actually quoted. Now, when I say 10% interest rate, it's nominal. Real means you have to adjust, you have to apply effect of inflation, effect of price changes to this interest rate. Now, to do that, there is a very small theoretical explanation. You call it Fisher equation. In this Fisher equation, this R, T, let's forget about this T, right? We don't need T. Then it's very simple. R is what? Real interest rate. I is what? Nominal interest rate. E5. E5 means this 5 indicate inflation. Greek letter 5 indicates inflation. E5 means expected inflation. What is the future inflation? That is the idea. So here we have simplified the idea. R equals I minus inflation. I think here this question mark is 5. It has not come properly. Alternatively, I equals R plus inflation. What does that mean? To get real interest rate, you have to deduct inflation from nominal rate. Let's say nominal rate is 8%. Inflation is 5%. What is the real rate? 3%. You can give this in a separate way also. Nominal interest rate equals R plus 5, which means nominal interest rate is 8. How it is composed or derived? Real rate 3% plus inflation 5%. So this gives an idea about the real purchasing power of this interest rate. Now imagine this 5% inflation, now it will become 9%. What will happen? Your real rate will become now negative. Real rate is negative. Real rate is not a good thing in the economy. Negative real rate is not a good thing. Why? When this interest rate is negative, depositors will be discouraged. They will not deposit money. Why? You are getting a negative return because inflation is higher. On the opposite, borrowers would like to have negative rates. Why? You borrow today, but you are paying less in the future because your interest rate is negative. People will borrow more. That is also costly to the economy. So authorities, central banks are trying to maintain a positive interest rate as much as possible. Positive real rate. That is one of the objectives of the policymakers. To do that, what they should do? They should control that 5, which means inflation has to be controlled. If you keep inflation constant, let's say at 5%, you can always have a positive interest rate if you maintain nominal interest rates higher than the inflation. So to understand it further, we have an example here. I need an answer from you. A bank pays an interest rate 15% per annum on a fixed deposit. This 15% is nominal interest rate. Okay. I. What is the amount of interest you get if your deposit is 100,000. So if you deposit 100,000, what is the amount you get for this rate? Let's say inflation is 10%. Inflation means I told you 5 during the year. Then what will be the real interest rate? Real interest rate means R. We already know. And as a result, what is the additional amount of money you get in real terms? So I need the answer. I need 3 answers. 2 answers actually. First, actually 3 answers, sorry. First one, what is the interest you get in nominal terms? What is the real rate? Third one, what is the real income? Can someone tell me quickly?
If we deposit 100,000, we will get 15,000.
Exactly. So wait a minute. What is that 15,000? It's actually the simple interest rate, isn't it? 100,000 multiplied by 15%. Correct. 15,000. Then the second one, if inflation is 10%, what is the real rate?
5%.
5%. Exactly. How do you get it? I minus by
Inflation.
inflation. Yes. I deduct inflation. I is 15%, inflation is 10%. So what is the real rate? 5%. So is it a positive real rate or a negative real rate?
Positive real rate.
Positive real rate. Correct. Is it good for the depositor or a bad for the depositor?
Good for the depositor.
Yes, he is getting a real amount of money. So what is the additional amount he get out of this deposit? In real terms, how many rupees?
5,000.
5,000. How do you calculate that 5,000?
Under the 15% interest rate, we get 15,000.
Hmm.
And the real interest rate is 10%, so it would be 10,000.
Yeah,
Difference is 5,000.
5,000. Exactly. Or the other shortcut is you already calculated real rate, isn't it? Real rate is 5%. So 5% into 100,000 is 5,000. Same answer. I think you got the idea very clear. Your answer indicates that you have got the idea very clear. So this real and nominal concept is important because people will decide their investment based on the real or nominal rate. So in order to justify this relationship, there is another theoretical idea called Fisher effect. So Fisher effect is given in this formula. Nominal rate is the combination of inflation and real rate. I think what we have already done. In other words, if inflation rate goes up, always nominal interest rate will go up. If inflation goes up all the time, nominal interest rate will go up. That is called as Fisher effect. But real rate, what will happen? It will always go down. So to keep real rate stable, if you want to R to be stable, what you should do? You have to stabilize inflation. Clear? So that is the role of the central bank, as I said. Now, this is the basically probably the last 2 slides for the day. Now, if you look at the economy, there are various interest rates. Different interest rates are there in the economy. For deposits, you have another interest rate. Let's say you have few deposits. You have 1 year deposit, 2 year deposit, 3 year deposit, 3-month deposit. All these are deposits rates, but the rate is different. Similarly, let's say you have different bonds. You have treasury bonds, corporate bonds, private bonds. There are different bonds. All these bonds have different interest rates. Why different products have different interest rates? Because of the two reasons in the economy. First, the risk. Second, the term. And here I have two charts from US context. So in these two charts, we have, in the first one, we have 3 or 4 types of instruments plotted, their interest rates. What are these 3 types or 4 types of interest? We have corporate AAA bonds. We have corporate BAA bonds. We have state bonds. We have government bonds. Now, if you look at these different interest rates, you will see BAA bonds will have the highest interest rate. AAA bonds have then the higher interest rates. State bonds, you have higher interest rates compared to government bonds, but lower than the corporate bonds. So as long as you have corporate or private bonds in this picture, you have high interest rates compared to government bond interest rates. Why is that? If you look at the risk for all these instruments, the risk is lowest for government. Usually governments are not defaulting, so they will pay anytime. Every time they will pay. So they will have the lowest interest rate because of low risk. But these BAA bonds, they are private bonds with some risk. They have to pay higher interest. So why this interest difference comes because of the risk factor. Okay, risk is an important factor of deciding different interest rates. Second reason is the term. Term means maturity. What is the period of maturity? Again, in this second chart, we have 3 instruments. What do we have? We have 20-year bond. We have 5-year bond. We have 3-month bond. If you look at the interest rate, 3-month bond has the lowest interest. 20-year bond has the highest interest, the red line. Why this difference is there? Because of the maturity or the term. If you deposit money in a bank, for 3 months, you get low interest rate. If you deposit for 1 year, you get higher interest rate. If you deposit for 5 years, you get more than that interest. So theoretically, this risk and term structure of interest will determine different levels of interest in the economy. Okay, next one. The term structure is really important for us to understand one important concept in the financial economics, that is yield curve. In the yield curve, here we have a picture of yield curve. What do we have? We plot the interest rates against their maturity. When you plot, you will see a 3-month will have a lower interest. 1 year will have a higher interest. 5 year will have another higher interest. 30 year will have more higher interest. So if you plot and connect those dots, you will get a curve like this. This curve, you call it as the yield curve. So in economics or in financial economics, financial markets, this yield curve is really important. There are different types of yield curve. Now this one is upward sloping yield curve. This is the normal yield curve. In an economy, what do you observe? A upward sloping yield curve, which means long-term rates are higher, short-term rates are lower. But sometimes you might see a flat curve, inverted curve. Inverted means short-term rates are higher, long-term rates are lower. So this yield curve is an important indicator for the financial market participants, because this will give some idea about future interest rates. People can get some idea about interest rates in 5 years time. So in the 5 years time period, interest rates are considered as higher than the short. In 30 years, it is considered as more higher. So this is a kind of an approximation of the behavior of interest rates in the economy. Investors look at this, whether the yield curve is upward sloping or downward sloping or flat. It's important. In the government securities market for treasury bills and bonds, this yield curve is really important. Okay, I'll show you an example from the Sri Lankan context. Now we have to understand one important thing. When we say interest rate, people get mixed up with the idea of interest rate and returns. Now these two are different. Why? Interest rate is simply the cost of money. To borrow or lend, what is the amount you pay or receive? Cost of money. Return is different. Return will indicate how well a person will gain out of an investment or a financial asset. If you deposit money, what is the return you get out of that money? It is dependent on the interest rate, but not exactly the return. To understand this, we can take a bond. Now, when you buy a bond, interest rate matters because the bond is priced based on interest rate. So you buy the bond and you hold it for some time and you sell it. When you sell also, interest rate matters. So your return has two components now. What are the two components? Return equals change in the price. You buy at a certain price, sell at a certain price. So the difference is the change in price. And also, if you have a bond, you get cash flows. If you buy a treasury bond, for that bond, you get cash flows based on coupons. Maybe every 3 years or 6 months, you are getting a coupon. These cash flows also part of your return. So if you take the price change and the cash flow as a percentage of your purchase price, bond price, that will indicate the return. It is different from the interest rate. That you have to understand. Interest rate and return are not the same concepts. One final point here I want to mention. Returns are associated with the risk. If you have high risk of a particular financial asset, your returns are higher because the compensation would be higher. Now, generally, if you look at the financial markets, I told you, key investment instruments are bonds and shares. if you look at the return for these two, for bonds, return are low. For shares, return are high. Why is that? For bonds, return are low because bonds have a low risk. I told you, if it is a government bond, government does not default. So return is low. For shares, return is high because the reason is shares are determined in the market based on the investment perspectives and perspectives and their ideas. So shares are generally considered as high risk investments. You can lose money at any point because of the value loss. So they have high returns because of high risk. So that's why people say in general, if you observe, if someone is paying a higher return to you, you have to be very, very careful because there is a high risk. Now, one good example is these unauthorized deposit taking institutions, they are paying high interest to you, high returns. Not exactly the same interest and return, but let's say they are paying you high. What does that indicate? You are experiencing a high risk. For pyramids, you get a higher return. Maybe 100%, 200% return you get for your money in illegal pyramid schemes. So what is the indication? You are facing a high risk. So whenever the high return is there, you have to be very cautious whether you are getting actually a high return based on economic principle or just merely because of risk. Okay, so those are some basics of the interest rates. In the next part, I am moving to interest rates in Sri Lanka. Okay, there are various interest rates in Sri Lanka. Central bank is deciding the benchmark interest rates of the economy. We already know. I'm going to discuss this in detail in the next week, and also we will look at some exam questions. You guys have a homework to do. What is the homework? Slide this slide. Okay, I'll put a star mark here. Can you see my slide, students?
Yes, sir.
Okay.
Yes, sir.
Now in this slide, in relation to Sri Lanka, there are various interest rates given here. AWPR, LR, NLR, WDR, FDR, NDR. Likewise, I have mentioned 6 key interest rates. All these are key interest rates in the Sri Lankan market. So your task, you have to come up with definitions of all these interest rates. I'm not going to give any definitions in the class. This task is required to be performed by you. I'll be giving some idea what is meant by that definition. I'm not giving you any definition in the class. So you have to come up with the definitions. Where do you find definitions? It's available in the Central Bank Annual Report, Chapter 7. Okay. Can you do it when you come to the next class?
Yes, sir.
Great. So please do it. Find out the definitions. If you are able, find out the current rate. Basically, information is available everywhere. Annual
Can we
report.
find in Google?
I don't think it's available in Google because these are some localized rates. No, so Google you might find the numbers. Sometimes very rarely definitions also. I'm not so sure. But why don't we rely on Google? We have a very good source, the Central Bank Annual Report, Chapter 7. It's there in interest rate section. Okay. So please come up with the definitions. Let's have a discussion on the rates and their direction and their importance and also some exam questions. I will only do it if you come up with your answers. Okay. So we'll stop there. I think we had a very good session today, more than 2.5 hours, nearly 3 hours starting from 7. and it was very productive. So let's continue this discussion next week, and we'll finish it and with some exam questions. And I'm starting a new section next week. Now, up to now, we have covered money and interest rate fully. No, nothing is left. We have a very good understanding. Next week, we are starting with another important topic, financial institutions, right? All the financial institutions, key institutions on the earth will be discussed. And their balance sheets, their behavior, importance, everything will be discussing starting from next week. Okay. So we are progressing well, and you guys are basically following the course, I think, satisfactorily. I can see most of you are joining the class, answering, interacting. That is really nice, important. So
Sir,
yes,
at what time next week class will be starting?
usual time, sorry, 8 o'clock.
Yes, we have received at 8 o'clock Google invitation. So I have received.
Really?
Yeah, after that
Oh.
only they have sent 7 o'clock. So I missed our first session. That's half an hour session I missed. Anyway, I will follow the YouTube. So just I ask because of that.
Sorry about it. Sorry about it. Maybe I will. It was my fault as well. I told them the class will be at 7, and I sent the slides. Actually, even I didn't remind them, so it's my fault as well. Sorry about it. I thought since I have already informed you last week, it's at 7. You might be joining, but I also observed that link was at 8 a.m. So it's a mistake, right? But hopefully you can cover up with the video. It's available, and I think I discussed very clearly and slowly. If you really have any issue, I think the question raised by Quilini, right? So including
Yes,
you,
sir.
if everyone has any issue, please come up with your questions or anything. I'm very happy to give you a clarification next week. Okay, don't worry. Let me know.
Thank you very much, sir. Thank you
Yeah,
very much.
yes, watch the video first part, and I'm sure most of you have joined halfway through, so don't worry. So let's meet up at 8 a.m. next week, same time, and we'll go by our usual standards. Okay, can you upload the presentation in PDF? I think it's available in PDF form in the Moodle in your LMS. If not, please send a message to IBSL. It should be available. I think every one of you can download it, right? In PDF form, it's there. I don't know whether I can upload directly somewhere, but it should be available on your Moodle. And videos are also available.
So if it's possible, if you are able to give your number, then we can clarify if the time is changing. Is there any possibility?
Shall I share my email address, please? In that
Oh,
sense,
fine, sir.
otherwise I'll be flooded with so many calls in the office. I'll be in real trouble, right? So drop me an email any point. I'm really happy to respond. anil@yahoo.com. Okay, I have shared on the chat box. Okay. So Malindi has also mentioned the same thing. So sorry about it, Malindi, because of the time confusion. And I'll make sure next time if there's any time change, even I will also remind and communicate. Okay, don't worry. Watch the YouTube. I'm there. Thank you. So let's stop at this point. Have a good weekend and stay safe. Delta is very serious and dangerous. So please be aware of that. Take care.